They can't win either way, Eric, can they, right? If they do 50, bond market says you're clueless, continues to push the envelope. If they go 75, market says now you're panicky. You have no cred, as Victoria was just making the argument. Am I right or overplaying that?
I think that's fair. I mean, their credibility is, questionable right now, I think, in the market's eyes to begin with. I do feel confident they will go 75 based on this Wall Street Journal report, today. I think this is their way of signaling.
Feels that way.
Yeah, it does. But, it's really going to be, there's really no great out for them, where people are going to walk away from this meeting and feel good. The best thing will be that it'll be over, and there could be a spin for 24 hours that people maybe like, but it's really, I think, over, beyond 24 hours. I don't see anything positive coming out of this meeting.
Victoria, what's so interesting is your headline you came with today before we had this news was that you think a rebound's coming.
Yeah, I think we were kind of setting ourselves up for that before we saw the news today because, look, I think there's still some headwinds to inflation that can work themselves through over the summer. And if that happens, which means yields will start to calm down a little bit, then that's going to be supportive of the equity market. I mean, let's look at inventory to sales ratio. That's moving higher. We look at supply, both domestically and importing. That's doing better. Real incomes are still somewhat supportive there for the consumer. And if we have profits and margins coming down a little bit for corporations, that means wages are going to stop the climb they've seen. That'll moderate. That moderates inflation. That moderates yield. So we thought maybe with some positive growth components maybe over the next few months, and that doesn't mean growth is going to be super strong, but maybe better than expectations, that we could see a little bit of a rally. Again, we think there's going to be tremendous volatility for the rest of the year, but could see a little bit of a rally over the next couple months if we get inflation under control.
I mean, Rob, we seemingly went from a place where we're like the economy's really strong to holy you-know-what, we're having an imminent recession. And I just wonder if you look at some of the most recent earnings reports, I'll even use Oracle today. Now, I don't have all the color in front of me in terms of what they reported, but if it was so bad and the outlook was so dreadful, the stock wouldn't be up 9%. And it was a top and bottom beat, and we'll get you the color, of course, on that. But the world doesn't seem to be as bad as some would suggest that it is. And I also go to the Lloyd Blankfein thing, a tweet of a week or so ago at this point was kind of like, yeah, if I was running a big corporation like a Jamie Dimon, he didn't use his name, but I will because that feels to me like he was alluding to the hurricane comments, I'd be preparing for the worst too. But cool it on all of the crazy talk. We're starting from a high place.
Well, listen, I think investors have to do exactly what some of these corporations are doing, and that's prepare their portfolios for volatility, for downside volatility, because frankly, things have to get worse before they get better. The Fed is the most important actor in the room, and until they pivot and this liquidity paradigm changes, I think investors have to be defensive in their orientation, and that means they have to buy stocks that are resilient. So you have the optionality for when markets recover. They're resilient from an earnings quality standpoint. They're reasonable from a valuation standpoint. They're resourceful from a capital deployment standpoint. And if you can own through this time in equities that are like that, that are actually performing, you're going to do better than selling and trying to re-enter. We still think, Scott, that there's a good ways to go on the downside. Fair value is probably somewhere in the 3,500 range. That's where we would get interested anyway. You could certainly see markets overshoot and go lower than that to where Eric's talking about. But at that point in time, we're going to be more aggressive about getting invested, especially if we see data that indicates that the Fed can maybe change the aggressiveness of their approach.